Good morning, folks, and welcome back to Almus Market Mornings, your daily dose of global financial updates. With me, Shikhar Garg, your host. Now, we saw yesterday stocks were a bit wavering while after some decline that we saw, but there was also a decline across asset classes, we can say. We saw oil prices declining, the global yields declined, EM currencies weakened against USD. So there was a lot of action probably in sync. Not just that we've seen decline across these things, but also the USD INR premiums went below 3%. Now, is there any respite, Pankaj? What's your take? What should we be seeing at?
Thanks, Shikhar. Thanks, everyone. Basically, markets are taking a factor of global DM developed markets, how far they would be going on interest rates, and that's driving the overall sentiments in the market. Indian Central Bank is specifically, probably our Indian market is believing that our rate hikes won't be as per the magnitude which will be in the US, and that's the reason premiums are lower, currency is weaker. Yesterday during market hours, due to stronger USD, weak equities and weak Asian FX drove the market down and INR weaker. NSE Nifty fell by 1.5%, and rupee ended at an all-time low with an enhanced dollar demand seen even as many Asian currencies weakened to new cycle. We saw Korean won moving dollar Korean won moving higher than 1300, and even crude prices falling further below 110, and afterwards steadier dollar index did not help much rupee. Now we can perceive that 78.5 could be one resistance point, and then could be a 79. But all these are, as of now, looks like a clear kind of a view-based thing. There is no resistance which was imposed by RBI at 78.30, which had been taken away yesterday evening. Let's see how it gets back today. The market would also be watching dollar yen move, which is basically moved above 136, particularly on the continued BOJ support for a yield curve control. We assume that Japanese authorities should be acting on this very soon. Now, coming back to the data point, current account deficit for January-March for India printed at $13.4 billion, which had basically reduced from a USD $22.2 billion from previous quarter. Numbers need to be watched for April to June and that number will come with a slight delay effect. The most of the crude oil prices impact would be seen in the current account deficit, and we would be watching when the global liquidity is receding, whether the NRI remittances, transfers, those will stay strong or not. Post-Indian market closure, Powell testimony and RBI's MPC minutes were the key events. Powell in his testimony clearly reiterated that central bank is strongly committed to bring down inflation to target level with various tools at hand. So 2% is the thing which market is watching. They are watching actually Fed. Although he also highlighted that many factors outside their control added to inflation. He says monetary policies cannot address supply side, monetary policy cannot address war impact, but they need to bring down the inflation, and they are committed to do this. He also indicated on certain questions that now onwards the rate hike magnitude will depend on data dependency. He is clearly saying that 25 or 100, it all depends what is the inflation print and how they would like to act on that. He also commented that he would not avoid, he would not, rather than say that, he would not say that recession is not possible. He says that currently economy is very strong. These rate hikes can be taken care by economy, but to bring down the inflation, if we are creating a demand destruction, this can happen into a recession. And this market has lashed on, and market moved on a dollar, euro moved from 1.05 to 1.06, and yield curve moved lower almost 15-20 basis. So the The impact was very clearly that market less on a recession, and due to this, stock market was also flat. On the data front, UK retail inflation hit a new 40-year high of a 9.1%, which is highest among the G7 nations. While food and energy were the biggest driver of the inflation, it's worldwide the same thing. Pushed by workers and unions for wage rises also putting up the inflation. UK Central Bank is also likely to continue to raise rates, but much slower pace. Now, minutes of our central bank and the meeting which held on us June 6 to June 8th, that indicate the members are clearly focused on reining in the high inflation. More policy moves are warranted, and acknowledging and require and also pushing the government to address the supply side factors of inflation. That's an indirect hint to the government. The policy direction is very, very clear that we would be heading towards 6% by March 2023. One of the specific comments, probably from Patra, who is the monetary policy in charge also, he says that the repo rate objective should be such that it's higher than the 4-quarter ahead inflation expectations. Now, when we are reaching at March 23 closer to 6%, RBI would also like to see that they are targeting closer to or hoping that they would be able to achieve inflation of around 4.5% by end of FY24. All in this, we can summarize that there's a scenario of a major rate hikes by the major central banks, and which might move into a recession or slowdown in the economies. That's all from me. Thank you. Have a nice day.
Okay, Pankaj, that was quite good, and I think it was a much detailed understanding of what all the central banks are thinking. And what can we say? I mean, we are seeing financial markets moving all-time high for USD INR, KRW reaching 1300s after almost a decade. So there's a lot of action, and I still want to understand one thing, and it's a question maybe for all, that the monetary policy mentioned they can't address supply and war inflation. So, and you also mentioned that the monetary policy is going to tackle this kind of inflation by killing the demand. How healthy would that be for growth in the longer picture? That's a big question if they are trying to kill the demand instead of look at the supply or war side inflation. So that brings us to an interesting times to watch, folks. We'll be coming up again tomorrow with another update. Till then, with Bidadio, thank you so much for joining. We'll catch up again tomorrow.